Managing finances is a risky business because unexpected events happen. Forest fires, hurricanes, or even vandalism can cost thousands of dollars in damages. There are several choices we make to protect ourselves and our assets. We can choose to accept the risk and reduce it by taking precautions. Or we can transfer the risk to others by purchasing insurance. When you have insurance, a company compensates you in the event of loss, damage, disability, or death. In exchange, you pay premiums, which are regular scheduled payments that you and your insurance company agree on. So, how do insurance companies determine your premiums? Using a process called underwriting, insurers examine the particular degree of risk. For example, underwriters for home insurance premiums look at weather patterns and regions. They know that hurricanes are more likely to occur and cause damages in southern Florida than in northern Kentucky. As a result, insurers charge higher premiums in riskier areas. Why? So they can raise enough money to pay out the region's more frequent requests for compensation, called claims. For auto insurance, many personal factors affect the amount of risk for an accident. Underwriters examine your relevant risk factors, then estimate the statistical likelihood you'll suffer a loss and file a claim. Another factor that can determine premiums is the deductible. This is a predetermined amount you must pay before the insurance company will cover your loss. The higher the deductible, the lower the premium. Why? The insurance company knows they won't have to pay as much if you need to file a claim. And insurers know you may even take fewer risks if you know you'll have to pay a big chunk of change up front. So, what happens to all of your premiums? The insurance company takes yours and those from thousands of other insured people and pulls them together to pay for everyone's potential losses and expenses. Let's say your home was not only damaged but destroyed by a hurricane. You, like most people, can't afford to replace the home and everything you had inside. But you paid $800 each year in homeowners insurance, as did 1,000, 10,000, maybe even 100,000 other homeowners, which means the insurance company can draw from that pool of money to cover your claim. Insuring your home is just one of many ways you can reduce financial risk. Renter's insurance covers damaged or stolen possessions. Life insurance is designed to help cover costs associated with death, like funeral expenses. Health insurance offsets the costs of expensive medical care and prescription drugs. In addition to a monthly premium and a deductible, these plans may require a copay, a fixed fee, each time you visit a healthcare provider. Auto insurance typically covers property damage to the other vehicle, as well as personal liability, which includes injuries to another party. But you can add even more coverage, such as collision and comprehensive to cover repairs, theft, and other types of damage affecting your own vehicle. The more coverage you buy, the less risk you take on. That risk is then transferred to the insurance company. But keep in mind, the more coverage you get, the higher your regular premiums will be. Another thing to keep in mind, many states mandate you carry a minimum level of insurance coverage, especially auto insurance. That's why it's important to understand how it can work for you. So let's review. All types of insurance follow a few basic principles. An insurance contract transfers some or all financial risk from the individual to an insurance company. The insurance company pools the premiums paid by those insured and taps into that money to pay any covered losses or claims. Insurance companies make a profit if they pay out less in claims than they collect in premiums. And you, the insured, can benefit, because when an unexpected costly event happens, you'll face fewer financial risks and more peace of mind.